All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Interesting day out there in the market as stocks are falling, dealing with the coronavirus stuff. And, one of those where we have the gap down, but since then it's been mostly buy pressure, right? Here on the day, most of the volume even is to the upside out there. And, I don't read too much into it, right? And I know that's something that, you can read something into and everything else. But, in the context that we are in right now, I'm not reading too much into that. The bottom line, when it comes down to it, is the way the coronavirus goes is going to dictate some of the short term of the market. And we'll get back to that here in a moment. But let's start with the challenge. No new signals on the board here today. We have a lot of downside crossovers on the list. American Airlines, Apple, Chipotle, EWW, EWZ, JD, Microsoft. Nothing triggering, as most of these are coming off of new highs. American Airlines, the one exception there, but no trigger there as well. So nothing really to go after. There are no upside crossovers. At least there weren't 5 minutes ago. Yeah, and there still aren't any upside crossovers to speak of there. So I'm going to go into the close here with cash, and and kind of take the next signals as they go. So that's the challenge, and where the challenge is at here. Now, in terms of the broader market. Right? Oftentimes I get told, well, the news drives the market. Jeff, it's the news. It's the news that drives things. Jeff, we go up and down based on the news. It's always the news. It's not chart. It's not technicals. It's not fundamentals. And I always argue against it because it's been proven wrong so many times. That said, in the short run, minor oscillations, they tend to be news dependent. Right? We can look back. We can take a chart of the S&P, and oftentimes, right, we can look at it and say, there was this price action, and that corresponds to this news event that we saw, right? If we come in and we just let me get my my drawer here. But if we come back and we look at this pullback in the market right here in May and June, we can point clearly to one thing. If we look at this pullback right here, we can point clearly to another thing. This 2-day pullback, we can point to something else, right? There were some news events that drove those, mostly with the trade war, right? And you'll notice that the downward here, there were gaps down, but most days the market actually went up, right? There's only 1, 2, 3, 4, 5, 6, 7 candles in here where the market went down during that day in a month period of time. Ultimately, we'll look at this price action and go, that was the coronavirus, right? The price action that is today. The news doesn't create the long-term trends. That's driven by earnings and economics. The news can create short-term oscillations. It can create small pops and drops. And I know if I call this small, I'm sure I'll get told, hey, Jeff, this is not small, this is big. This is very small, right? In the context of things, we're talking about 2% so far. That's not even a normal or that's not even a shallow correction, right? And could it get worse? Yeah, it could, right? But, keep in mind that right here, right now, if we're talking about tomorrow, if we have reports overnight that, hey, the coronavirus is being contained and there are not a whole lot of new reports, the market's going to go up. If we have another spread and another couple instances here in the U.S. and maybe in Europe, market's going to go down. And that is, you are dependent there, right? So to look at something and go, well, I'm going to use the chart and use the technicals of the chart to decide what to trade till tomorrow, that becomes very difficult. That becomes extremely difficult to do. Now, in a moment, I'm going to go out and do it with hammers and piercings and show you, two things there and how to possibly trade them. But it's a difficult task, and it's not something that, I go out and risk a ton, to do. Take a look here. I'm going to expand the market back 2 years, because one of the things that people forget, very quickly they forget, is that when you're talking about downward moves in the market, you get big rallies, right? You get monster rallies that come in. You get, big downside hammer action, then this upside gap up, and then sell off that day. It's got to go down next. Nope, next day, big gap up. You start to get much more random action as the news kind of feeds into things. And so when you look at candle patterns and you look at technicals, the overall doesn't tend to be as consistent as it is when we're talking about, more upward trends, or when we're talking about reversals after, the selling action is done, like what we got in June, right? Which is a very nice time for the challenge. When we got that, boom, all right, easy to recognize, easy to run with, easy to go with. Easy as a relative term. But, it is one where there are a lot of pops and drops to come, okay, in this market. Could the market turn around and just go straight up to new highs from here? It could. It could. Would that be the norm? No. It would be very abnormal to see that without, some further action within this area, maybe even slightly lower, here, given what the metrics look like. But that said, we will have big rallies during a pullback. If we are in for a 7 to 10% pullback in the market, we will have some big rallies during that period of time. So keep that in mind, especially if you're looking to short. Take a look. There'll be some updates to short that you'll have the chance to to go after there. But on a day like today, I know most traders, they see the market, okay, gaps down, and then they see pretty much it's all buy pressure most of the day, right? Things starting to go green. Lennar, Arconic, they've been green all day. Target, Walmart, Johnson & Johnson, right? They're starting to see green pop up on their board. They're seeing stocks that are well off of their lows. Apple a few bucks off of its lows, Visa a little off its lows, UPS, and they start to look and go, okay, we got some interesting candles out there. Take a look at UPS. I mean, this is a hammer, right? We got Thor's hammer here, and so what do, right? Well, take a look at a hammer right back here. What happened? Yeah, the market went up, or UPS went up. Did it go up the next day? The day after that? No. It took a while, right? It took a while. We had a nice little hammer right here. Same thing, right? These hammers are very interesting candlestick patterns, and I really like to trade them. All right. That said, they're about 60% accurate. Okay. So if you're looking at a hammer pattern and you're looking at getting follow through to the upside, or that this is a reversal off the downside, it's about 60% of the time. Okay. What does that mean? Well, 60%. That's not huge in my favor, right? It's not huge in my favor. If I go and I look at the option values, and I'm right, and it goes my way, what's going to happen to the implied volatility? It's going to go against me a little bit, so I need to be right, and I need to be right in a big way. Doesn't mean there's not opportunity right here, but you have a low probability option, and you have 60% chance of it going your way. Something I'd be willing to trade? Yeah. It's not something I would look at and say, no, I'm not willing to trade. I've traded worse odds before. But it's something that I have to understand and put my exposure accordingly. I mean, if I'm going out and trading it, if I want to go bottom pick with it, or, a FedEx, which is a similar chart, not quite a hammer, right? But yeah, similar lower Bollinger Band, kind of past support area. Okay, a little far from the 7, fine. I have to put my exposure, in line with what I'm willing to lose. Because the reality in this market right now, the risk exists that you wake up and UPS is trading at 111. that reality, that risk is always there, but it's not normally very high. Right now, it's very high, right? If you want to go short UPS, well, you have to account for the risk that it goes to 118, 119 tomorrow, right? Not that that's a high probability, but that risk factor is out there, and that is one of the reasons why the option prices are expanded the way that they are. Now, UPS has earnings, upcoming here, so, that's another possible driver. But bottom line is there are several hammers out there, right? We can go do something like an FFIV, right? Nice little hammer action. ISRG, hammer fading a little bit. Marriott, nice little hammer action out there. There's a lot of hammer action out there, and keep in mind it's 60%. Right, it's 60%, and oftentimes my favorite way to play a hammer, something like a Marriott, is to wait. If it gaps up and goes and I miss out, fine. But let it pull on back, maybe a day or two. Oftentimes we'll see that. Then I can jump in, use the low of the hammer as my stop price, and go from there. All right. But Marriott, big hammer right here. The next day, big gap down, breaks into new lows, right? Hammers, if you go look at them, they're not the most accurate of the candlestick patterns, but they are, one of the, at least they're above 50%, which, most candlestick patterns are around 50%, which is flip a coin. Hammers, they're in that 60%, 60% area. Now, something that's a little more accurate are piercings, right? And if you take a look at Walmart here, we have a piercing candle where we gap down and rally on back, and we're not fully engulfing the prior day price action. Almost. It's rallied a little bit since I looked at it earlier, but we're erasing much of the prior day's action after a gap down. Both Target and Walmart have this piercing action that's now actually turning into engulfing action to where it's fully engulfing the sell from the prior day. Both piercings and engulfings are about that 65% accuracy, which makes them one of the higher accuracy candle patterns that's out there. Okay. And it's one where accurate if you're using it as a reversal. Okay. If you're using it as some sort of trend continuation, no. But here in the case of both Walmart and Target, we are talking about a potential reversal because we have bullish engulfings or bullish piercings after a sizable downward move. All right. So we're in that 65% accuracy area, with them. The stocks are up a little bit today, so the implied volatilities haven't skyrocketed like with some other things. So there's some decent opportunities with them. Obviously you do have to take earnings into account, but both of these, and I talked about Walmart this morning, the price action is just different today, and I'm not in yet. But I'm going to take the same approach that I would take with a hammer, right? I'm going to go into tomorrow, just because of broader market conditions. I'm going to go into tomorrow with Walmart on my list. And if we pull on back, I will look at picking it up, right? I will look at grabbing it. If we see it, pull on back, start to rally, great. I'll go grab it. But with everything that's going on right now, I'm not willing to have that exposure. Right. And again, it's not bad exposure. It's not something that says, hey, Walmart can't go to 120 tomorrow. But it's not exposure where the odds are high enough for me, given the market condition change that we are seeing. Okay, and we've talked about it. The bullish percent index, the market vibe turned bearish on Friday. Here today we had the bullish percent index pulling on back, and we now have a confirmed bear signal out of the bullish percent index here today. And this has just been something that's just been up and away. It has just hardly pulled back on any type of small market pullback. And, we now have a confirmed bear signal out of it as well. So, my eagerness to want to buy on the upside, given that options are overvalued because of implied volatility and market conditions and metrics suggest further move to the other side, it just kind of keeps me from wanting to have, too much upside exposure. And puts me in the camp of wanting to look to sell rallies rather than to buy dips for the foreseeable future. Okay. Tomorrow, we'll talk about that. We will talk about selling rallies. Hopefully, we get a little bit of a rally. We'll talk about how to sell rallies when you expect correction environments to happen, because there's a big advantage to selling rallies. Selling rallies means that you're paying less on your option. The implied volatilities tend to fade. And then you get what? You get an increase in implied volatility as the stock goes down. But selling rallies can be, a little iffy, from time to time. And so I'll show you some of the techniques that I use or things that I look at for selling rallies, and some of the things that I'm looking at right here, right now. Some of the stocks, and we'll take a look at those. We'll take a look at those tomorrow. All right. But for now, market vibe remains bearish. We do see a confirmed bear signal out of the bullish percent index. In the short run, we are going to see, the coronavirus, ultimately drive some things in the short run until we get a few more earnings here for the market to kind of digest and take into account. But there'll be another interesting thing there with China. But those are some hammers and piercings. If you're, absolutely convinced the market bottoms in, you want to go, trade on higher. And then tomorrow, we'll talk a little bit about selling rallies. For the challenge, again, no new signals, so we'll go into cash, or we'll, go into the close here in cash. Again, we don't need a lot of trades. We just need good trades. And so, I'll continue to be patient for those signals to come on in. Thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you tomorrow. Take care.